you up here. Hey, good morning, everybody. We're going to have a few more minutes for some people to jump on here. Hope everybody's having a great day. Look forward to having some nice discussion here today about our market update and a deep dive into the custom products and contracts. We'll be starting in about a minute or so. Well, hello, everybody. Welcome to the November webinar. We're going to be having a nice discussion today. My name is Scott Ebeling. I'm Director of Pricing and Strategic Solutions here at Box. And joining me is Allison Coldewey, our Senior Pricing Analyst and Strategic Solutions Analyst. We are looking forward to having a nice discussion today regarding, talk about Box. We're going to have some updates as well. And then we're going to go into a little market update. Allie's going to have a nice feature on the custom products overview and discussing that and different products and different uses for those. And then I'm going to go in a little bit about contract language and why it's really important to pay attention to this and why it's not always apples to apples and you're not always getting what you want. Allie, why don't you start out here talking about Box for a little bit?
Sounds good. Thank you, everybody, for joining us this morning. We appreciate it. I'm really excited about this webinar. I think it's getting back to back to our roots, which is always fun. For those of you who don't know who Box is, maybe you're not a Box partner yet. Box is a master electricity broker. So we help independent energy brokers to bring new suppliers, new products, and to market in different territories than perhaps they ever could before. We're licensed in every market. As you can see, the map on the screen, we've got our natural gas only markets available in green. We've got both power and gas deregulated territories available in blue. And then we've got some dark states that have a little stripe across them. Those are limited availability states. Most often that pertains to large commercial and industrial natural gas customers. The United States is deregulated nationwide for natural gas. So if you are a large commercial industrial natural gas user, or you know one, or have some of those opportunities, definitely reach out to us. We've got a robust suite of resources, and we're happy to put them to use. On that note, we've also got a ton of suppliers available at our disposal. So you'll see a lot of our big names on here: NG, Direct Energy, NRG brands, Constellation, Dynegy. Our team at Box has a ton of industry experience. Scott and our other founders have all worked at suppliers in the past, so they know suppliers. We've got great relationships with all of our partner suppliers. We're able to provide additional flexibility and bring just a little bit more leverage in terms of our negotiations because of the scope of brokers and business that we represent. And again, we're happy to put those relationships to work for you. I wanted to go over just some updates for us here. Box, just so everybody knows, I know we put it on social media, but we're really excited. We were a finalist for TIPA's ABC of the Year. So TIPA is the Energy Professional Association. It is a national association of brokers, suppliers, and service providers in the retail energy sphere. We get people, TIPA spans the whole nation. It puts on events in both on the East Coast, in Chicago, Baltimore, Philadelphia, as well as in Texas. Their annual event, their big annual conference was last week, and Scott and I both attended. It was awesome. It was super fun and very informative. And we were named, Spox was named one of their top 4 aggregated broker consultants of the year. So we are honored and wanted to share that with you guys. We wouldn't be there without each of our partner brokers. So thank you guys for your participation, your support, and thank you for doing business with us. We wouldn't send you, like to say all the time, we wouldn't be here without you guys. We also wanted to go over our upcoming holiday schedule. As everybody knows, we do have a holiday coming up next week. It's the good one. It's the one with lots of food. So we are going to be closed for the holiday on Thursday as well as on Friday. And we'll be taking a half day as well that Wednesday. So we'll be closing down at noon Central. I know some suppliers may also be closing their doors. We may have a little bit of intermittent service on Wednesday. So if you do have some business that is looking to close, highly recommend trying to get it across the finish line by this Friday. End of day, holidays are always just a little bit weird. We will, of course, do our best, and we'll, call, call anybody that we need to get it done. But just so you guys know, that is upcoming. And last but not least, we are hiring. We are hiring for sales. We are hiring for some operations roles. If you guys are interested, if you know somebody who thinks would be a good fit, whether that's somebody who's just getting their start in retail energy, or somebody who has been in it and is looking to expand their knowledge and their skill set, or looking to bring their knowledge and skill set to Broker Online Exchange, we would love to have some conversations with them. So if you guys know good people, send them our way.
Well, thank you, Allie. That was
that's
awesome.
It for our
Yeah, we're growing. That's the good news. We are growing, and we're also trying to staff up, beef up, so we provide better services to all our current brokers. Well, I'm just going to go into a little market update here. Start out here, we're just looking to look here at the natural gas prices. And again, we talk about natural gas a lot because that is the fuel on margin throughout, and it really kind of sets the power prices, correlates really well with the power prices and kind of sets it. And so we look at the fundamentals of there, because that's truly the main fundamentals that are really going to move the markets for both power and gas, of course. And so if you look here, this is a 12-month strip. Just looking at the next 12 months out. It's a good gauge. You're looking at this last 2 years. And you can see we're kind of been up and down, up and down. It's been extremely volatile summer period here and fall, but it looks like we're settling in here a little bit on bouncing around that $1 range between $5 and $6, but also looks like all those floors being set there at around $5. So these are the levels here. If we get down to that $5 level, which is probably today, we're down about $5.15 or so. These are good times to buy in these strips, because it's unlikely we're going to really punch through that bottom floor. Going to natural price curve here, this is kind of looks out where that each month is on the curve. Of course, these peaks are the winners, and we keep the winter peaks keep on falling down further and further. But this is comparison between a month ago and today. And you can see there's movement downward in the kind of out through winter of 24, and then it's the same, no movement. And that's because I, really truly believe that, the new floor here is in, and that's around that 450 area, 4 to 450 area, but for the strips around 450 in gas. So we are there. Great time to hedge. Always get a piece of that position there, because we don't know what the fundamentals are upwards, but there's definitely much more upward upside risk and downside risk. And then we're gonna look at the power price curve, same thing going out through. And this is the orange is ERCOT, the green is Mass Hub, and the blue is PJM Hub. And you really see here, one of the main things is Mass Hub winners are much higher. That's due to the need to import LNG, which is significantly more expensive. So, we're talking in the 20s for gas out there in the winter months, this coming winter and also next winter. You see why it's a much bigger difference. But again, these are good charts here, and these are power price curves. And all brokers, if you guys want any of these specifically for a couple of these to show in a presentation, we have access to the data. We can definitely put these in a form for you, as well as provide block pricing. And the one more thing is ERCOT. Look at ERCOT in orange. the summers used to sell for over 100. Now everything's under really $100. This is around the clock pricing. And also the winters as well. So the summer and winter risk premiums are completely evaporating, and really that's because all the solar that's expected to come online. We definitely see this as as interesting scenario, especially for the winter. I think everybody has really, their memories have not faded really at all from what happened in Uri and the $9,000 LMPs. Not to say that's going to happen again, but gosh, winter prices here in the 70s and below looks quite enticing. Energy price trend. And this is just kind of what the calendar strips are and really what the price change has been. Big drop there in 2023 for many of the hubs here in New York and PJM, not as much in ERCOT. But again, you can see ERCOT pricing in the 40s and 50s, PJM fading as well. It's definitely a backwardated curve. But these are prices that were much higher, much higher a few months ago. And looking at natural gas storage, we've had a big jump here in storage, really a perfect weather scenario in September, October. What is vital to bring these storage levels back to average. But I do want to make a quick note on this, and that is that if Freeport LNG was online, that's a little over 2 BCF a day, went offline in June, we'd actually be sitting around 3240 right now. So despite having a perfect fall, definitely it was above normal summer, but it wasn't extremely hot. Throughout the rest of the country, in Texas, it was pretty hot. We're going to still be sitting at 3240. So you see, there's still, like, when Freeport LNG comes online, unless we have a production increase, there's still kind of a somewhat of a structural deficit to the system, this could cause issues, and why we're seeing some winter fear gauge, for instance, really kind of starting to change here a little bit, and it's flip-flopping to the fear now is more in 24 than it is in 23. And this measures difference in gas premium from winter to spring. So April being spring, March being the end of the winter, and it has that fear of which there's going to be a shortage, a supply shortage during that time. So this is interesting that it's collapsed this much in 2024 has taken over. So now 2024 is where that risk is at. This spread could widen out for 24, all depending on what happens here with storage. Also 23 could spread out too if we have really early cold. And now production, is it limited? That's the question. We were behind the EIA levels, the estimates they had beginning of the year, and we're pretty much on them right now. But there's signs that this could be topping out, and really, it probably will be topping out, because producers have been, on their Q4 earnings calls over the past month, have been guiding down their production estimates for 2023. And they've also, one of the main reasons why is because there really isn't takeaway pipeline capacity right now, is limited. And that's really due to new projects being blocked. It's a permitting process. These are, billion-dollar pipelines. Some of them are being half built and then they have to be stopped, costing people a lot of money. So there's really no appetite to really even partake in this process, even to try to even go after the permitting. And this is, it's all physics at that point. You can't really drill and produce if you can't go anywhere. And so, that being said, that's what is going on. Now everybody could say, like, well, hey, there's a lot of wells, there's still wells being drilled, there's still drilling. Yes, that's because there's a huge decline rate in these wells. So they need to keep drilling and getting these things online, because there's going to be decline rates in the wells they built last year and the year before and the year before. So they need to, it's not just you drill a well and for 20 years it spits out the same amount of BCF of gas. It's the big decline rate from year 1 to year 2, year 2 to year 3. So they need to keep doing it to, keep drilling to keep production even. Freeport LNG, this is a big news one. This moves markets, literally, even false reports. There was actually a report last week on Friday, late in the trading day, a tweet came out with letterhead from Freeport saying that, it's going to be delayed through well into next year due to some cracks in some pipelines, and which was Freeport came out after market close, completely false. Market went down 50 cents still on the news before the market could open. After the market closed, Freeport announced it. By Sunday evening, when the market opened up again, we were right back up 40, 50 cents. And we all saw that on Monday. This is really causing issues. But Freeport is now delayed until January 2023. Last time we were in the call, we expected to be in line in mid-November. Now it's January 2023. So that's going to add, we got that 75 or 90, 100 BCF of gas into storage that we didn't expect, which is good. Again, strengthening out the winter storage levels, and likely not going to have a causing issue. That's that fear gauge we saw a few minutes ago. Freeport delay is causing U.S. historic gas that otherwise would have been exported. That's why it's, and we saw this question in the last one, I didn't get to answer it, but that's why we talk about Freeport and why it's important, because when Freeport is delayed, that gas isn't going out, it's being just swallowed back up in the storage here in the US. But I do want to note here, this is really important. There's 6 BCF a day of gas. I mean, this is going to come online, be exported by the beginning of 2025. The only way it won't be exported is if there's major delays in the construction, and there's not. In fact, lately, there's been, some of these projects have been done quicker. Really, they want to get on, there's totally incentive to get them done as quick as possible because the gas prices are 5 times higher in Asia and in Europe. So, and we expect it to continue. This is 6 BCF a day of additional gas. And going back to the production thing, if we don't get this production up 6 BCF a day by 2025, we are going to have a structural deficit, and it is going to cause major worries and major concerns and much higher prices here. And that's in that meat of the curves we talked about, where these prices are in the $4.50 area for scripts and gas, and the power is generally in that, or ERCOT's in the $40 area, PGM's in the low 50 area. Other market developments, I just want to let everybody know, sweet spots for 95% of power pricing are end dates in November for NEPOOL and New York. So in December for MISO, PGM, ERCOT. Doesn't matter when the start date is, but for energy portion, these are anything that ends in November for NEPOOL and or December. That's where your sweet spot is going to be for any time ending in that calendar year. Yes, there can be differences based off of capacity. Capacity is backwardated in PJM, so that's not really an issue. But there is not. This is the energy portion. This is where you're going to see those sweet spots at. And if you want to have the lowest prices for where it will be at, but I'll tell you though, it's not a huge difference between say December and January. It's not humongous. It is in NEPOOL, but there is a slight difference. That's where you want to get the sweet spots at. It's not going to be a September end. It's not going to be a July end. It's not going to be a February end. It will be this is where you want to end it at if you want those lowest sweet spot prices. The Massachusetts governor that was recently elected, just to give, is an opponent of retail energy choice. So something to be aware of, especially with potential some major issues this winter. 50 gigawatts of coal electricity capacity is going to be retired by 2029. Just as a side note on that, 2022 was a record for global coal consumption. That's quite an interesting thing that I was kind of surprised to see. But then again, we are just one country here, and other countries are trying to really grow, and this is where they need energy to grow, and all they have is coal. And be on the lookout for supplier price adjustments and lack of supplier pricing for winter 2023 in NEPOOL. We've already got some notices, and especially in the gas side, that they're not pricing out this coming winter, and that is really due to the extreme volatility that's expected there. And with that, let's talk about a little about strategies. As we talk about always, one, be disciplined. Remember, these consumers or customers, ultimate customers, are not taking a long position. They're just covering a short position. They oftentimes think they're like, hey, I don't want to take a position here. Well, Mr. Customer, you already have a position. That's a short position. You're just trying to cover that. So risk manage appropriately. Set a strike price. Increase the chances of participating in a market dip. For instance, a rogue tweet. Yes, you might be able to participate in that market dip if the market dip's there and they can get it. This is when especially the larger customers, when we have a strike price set, coming from a trading desk myself, we'd have those pieces of paper there. We would try to fill those pieces of paper. It was much easier to know that we already had the other end signed and sealed and we could execute on it versus always having the price at the offer side. And that's what suppliers do, the price at the offer side, because they know that's where they can buy and hedge immediately after a deal is signed. But it's not just the offer side, it's the offer side plus a little bit extra, because again, they don't know what the execution risk is as far as the deal signed, they get the word on it and they get executed. That could be half hour, hour time period for to even price it out. It could be 2-3 hours to get it executed and signed. Set the strike price, trust me, it can get you that extra 50 to 75 cent difference right off the bat sometimes, and definitely help you participate in the bid is in order to go back to the customer and get approvals just to get the paper signed because of the price dip. As you see, these price dips are here and then they're gone. And finally, hedge something. You don't have to hedge 100%. You hedge 25% and you get something in there. It's layering these things in, having timing, having a strategy, doing them the first Tuesday of every quarter. For example, work with us and we can help you guys develop strategies for your customers on hedging. And with that, Ellie, I'll let you take it away with the custom products.
Awesome, thank you, Scott. Today I wanted to go over our custom products. I know for some of us on this call, specifically our supplier partners, this is going to be going back to basics, kind of learning the ABCs again, but it really matters whenever you are looking at the price of electricity, what is in that price. So I want to review components, I want to review different strategies for managing the energy portion of the price. I also want to go over everything else and management strategies for some of those other components. So just starting from the very beginning, this is the average anatomy of an electricity price. This pie graph is a little bit different in Texas, in ERCOT, which is known as an energy-only market, meaning that it doesn't have the capacity or transmission pieces. They do have ancillaries, losses, and some renewable components that are under that ancillary fee. But in general, this is what you're looking for, or this is what you're looking at. Whenever you're looking at it, the majority of this power price is going to be energy. This is the cost of your commodity itself, the actual electrons that are traveling on those lines that make your lights work, that run your refrigerator, all of those wonderful things that we can do in the 21st century. This is usually calculated by a supplier as the cost to purchase the amount of power that a customer needs in the wholesale market for the specific length of time. So what the supplier is going to do is they're going to pull the customer's historical usage. They're going to look at how much they're using at what time, and they're going to measure based on the wholesale cost that they're seeing at that point, and they're going to be able to lock in a price. Capacity, ancillary services, transmission, renewable portfolio standards, some of these other factors. I was thinking about it yesterday, and really these guys, these components are not necessarily as volatile as energy. Energy is a commodity. It's traded real time, similar to some metals, similar to other commodities like corn. So that price is moving. We also have regional prices of energy that depend on grid conditions, capacity of the grid, temperature, and overall demand. So there are some pieces with energy that whenever we're talking about hedging something, that's what we're talking about, is protecting yourself from the actual regional volatility that you can see with real-time pricing or with day-ahead pricing in wholesale electricity markets. These other components, capacity, transmission, your ancillary charges, Some of these are actually a little bit more similar to the charges that you see on your utility distribution side of the bill. These are charges and components that are managed by your independent system operator or regional transmission operator. They are calculated well in advance, and they're based on assigned values, both from auctions, which again happen in advance, and then as well from the customer's values that are assigned by either the local utility or, again, the ISO. There's different ways of managing those pieces, but we're going to talk about energy for a minute here. Looking at energy products and prices, you've got fixed pricing, you've got index pricing, and you've got hybrid pricing. You guys have probably seen something that looks a little bit like this before, but in general, your higher prices are going to be in your summer and your winter. If you remember those spreads and the real-time pricing strips that Scott was showing us before, all of those peaks, all of the highest pricing was going to happen in your summers and your winters, and spring and fall are known as shoulder seasons. Those are when prices are going to come down. It's no coincidence that prices spike whenever everyone is using the most amount of energy, which is why it's advantageous to put some sort of fixed price in place so that you're not using the most power whenever power is also the most expensive. Fixed pricing does allow for budgetary certainty and price protection, but the downside is that if you sign a fixed price in a high market, then yes, you're protecting yourself from all of that upside risk, but if the market does come down, then you're not necessarily allowed to participate and recoup some of that and decrease your price. You're signing in and taking a long position in the market. That's literally exactly what that means. Now, there are some cases, if you're in a fixed price and the market has lost half of its value and you're into your contract a little bit, where we can renegotiate that and do what's called a blend and extend. Reach out to your account managers if you have people who are in those positions. But for the most part, what we're looking at is fixed price. That's a bet that pricing is either going to stay the same and go up, and you would rather have that security. This is a great product. Fixed prices are great products for the small and medium business segment, really because there's not necessarily any advantage to them or a significant advantage for them from a cost perspective of passing through some of that energy and taking on that risk. However, so the premium needed to fix that price is going to be something that maybe they're paying, maybe real-time pricing would have been $10 less, but you pay that $10 as a premium to make sure that you're not getting a bill like several people did whenever Winter Storm Uri happened, and small medium businesses who were paying $500 a month were all of a sudden looking at bills over $10,000, and that's really that's protection, and it's worth that $10 a month for you to be able to have that peace of mind and budgetary certainty. For your larger customers, however, we definitely want to look at index prices. We want to look at hybrid prices because there may be some advantages to passing through some components, whether that's partially passing through energy during times when we know that the energy cost is going to be low real time, or whether it's looking at some of the more stable components like capacity and transmission and deciding, what, we can estimate those within a reasonable margin. There's really no need to ask a supplier to fix that because then they're going to put a risk premium on it in order to fix it. We would rather just pay for what this component is at cost, given that it's not as volatile as energy can be. And that's part of what we'll talk about on our next slide here, looking at our non-energy components. So suppliers provide different products so that customers can choose how they want to treat each component. And understanding which components are included or bundled into the price on the contract is critical. Like I said, in some cases, components may be included in the quote. In other cases, they may be passed through as individual charges. The most common product, a fixed all-inclusive product, should contain all of the components that we were looking at in that pie chart. It should contain energy, it should contain your capacity, transmission, ancillary charges, any renewable portfolio standards, really anything that can influence your supply price should be in a fixed all-in price. We are seeing some seasonal components that suppliers are starting to break out. We're seeing some other pieces where even if a component is fixed, suppliers may still be able to adjust it midterm Again, sometimes that's advantageous, but sometimes it's not. But the most important thing is that you've got to be familiar with these components. You've got to understand how each component is treated throughout the contract in order to articulate to your customer, either you're going to be safe paying this exact rate that I'm showing you for the next 2, 3, 5 years, or yes, we believe that this is the rate that you're going to be paying, but the supplier may be able to make adjustments to this rate under XYZ certain scenarios. Most often, they can make adjustments to either capacity language or transmission language. Customers are assigned new values by the utility every year. And in most cases, if your value goes down, that means your cost also goes down. In those situations, it's advantageous for the customer to have passed that cost through because they will actually see that cost come down. Whereas if they were to fix that cost, suppliers may or may not adjust that price down. There are products where there are bilateral products where customers can benefit and where they will see some of that return under a fixed price. However, you can bet if your tags go up, then your supplier will also be adjusting the cost up because it's going to cost them more to serve you. So whenever we're talking about each of these components, again, it's critical to understand exactly what is going into the price on the contract. If the price on the contract is not including some of the components, that doesn't mean that the customer doesn't still have to pay for that component. The customer will get billed for that component. It's just not in the fixed part of the contract price. And it's very important that all of us articulate that to our customers. It's important for all of us to convey when and how suppliers have license to change pricing under certain product structures. And on suppliers changing products, we'll talk a little bit on contract language next. So Scott, I'll pass it back to you.
Thanks, Allie. Yeah, it's a great segue into discussion here about the contract language. You already started that off there, great. So yeah, I mean, first of all here, let's really talk about this fix. Does not mean a supplier can't adjust the line item on the bill. We've seen it from all suppliers. It happens. They're not in the business to lose money. This is a low margin business for suppliers. So they're protecting their risk side all they can on the contract. So we just want to put that out there right away. They can't adjust the line item in the bill. Regulatory changes, increase in transmission or capacity costs. There's multiple different things. Usage changes to the customer. There's multiple things in the contract. So, what we're trying to get to here is bandwidth, material change, quantity variances, swing percentages are all items. Really got to make sure the customer's future profile matches up to the contract language. Somebody can have cheaper pricing and they have, swing percentages at 25%, and that's going to be fine. If it's a hospital, they're not growing at all, it's all good, right? I mean, but if it's a manufacturer and they're growing, that extra mil, that could cost them 10 mils, $10 a megawatt hour in the end. It is really important to understand the language that's in the contract and fitting to the customer's needs. Another thing, supplier contract language is, typically unilateral. Does not favor the customer. There's things in there that you want to get shifted to be more bilateral in language. And again, it's all kinds of language. You might not think you need it now, but you might need it later. And it's important to kind of work on this. Suppliers are generally going to be flexible in cognizant and trying to change language. Some suppliers do not include losses in the fixed all-in price and instead gross up the usage to account for losses. Now this is completely fine if it's energy only, because and you just kind of gross up the usage there, because all the other stuff then is the pass-throughs are all, especially the big ones, capacity and transmission, those are kind of a fixed base rate based off demand. It's not really usage like kilowatt hour usage. But when it's fixed all in and they gross up the usage, it's a way for them to kind of increase their revenue, because now they're basically taking extra usage and really just taking that extra usage and applying that to the transmission and capacity kilowatt hour rate, and it can add to the cost. So I've seen many examples where it looks like one supplier is $2 a megawatt hour cheaper, but they gross up the losses in that bundled rate, and it really comes out to being, $2 more expensive than the other supplier. These are really kind of hidden. It's even hard to even see it on the bill unless you're really looking for it. We do look for that stuff, and we do have lists of who these suppliers are, and we look over the contract language. We actually do look at that. Suppliers love the fully bundled fixed product because, if non-energy costs come down, they are not obligated to lower prices. And they often keep the margin. We saw that in capacity because, remember in PGM here, well, we're still behind in capacity markets, but capacity dropped almost 50% in a lot of the markets, and prices were when they were set for capacity to pretty much stay stable versus the previous auction year, the latest auction period. And there wasn't any adjustments. And these weren't necessarily hedged by suppliers at these levels. The market for capacity is not that robust. So they didn't make these adjustments. And they're not obligated to make those adjustments. But if costs go higher, they definitely will. So through adjustment to the customer. Again, and it might say fixed price, and that price might not change, but there could be a line item on the, oftentimes there's a line item on the bill. That's the adjustment part. If a customer has multiple locations, add delete language can be negotiated with some suppliers and quite a bit of them. So again, let us help you guys negotiate that. We can work on that with you guys as we go through. Finally, let Box help you guys navigate these supplier contracts. We read them, we know them. We've got matrices as far as like what to look for, and we can help you negotiate the best possible contract terms for the customer. Really, it reduces the risk a ton, and it's an extra service that can be provided to your customer that just builds that trust even more, and trust is so important. And that is, I believe, all we have here today. Do we have any questions at all? I see one. Yeah. Okay. Yeah. A question came up here of, can you name the suppliers that are grossing up losses? And we're not going to name out suppliers on the webinar here. We do have a list. We do have some of the contract stuff, and we continue to review. In fact, we just are now doing a full review, getting updated contracts from every supplier to do a full review, which we're going to start doing on an annual basis. Check with us when you're doing these, and we'll start flagging them for you if you guys ask our desk here. All right, that's all we have.
We had one.
Oh, we have one more? Okay.
It looks like we had one more. Yeah, we got what is considered a large customer, talking about some of the strike prices and hedging strategies, hybrid products, things like that. Whenever we're talking about those, in general, we want them to be 5,000 megawatt hours or 5 million kilowatt hours a year. But there is some availability, especially in this market, for customers that are a little lower, maybe at the 2 or 3 million mark. So that's when we can start getting into some of that fun stuff. And customers of that size certainly have more options than your small, medium business classes.
That's good, Allie. And I just want to add to that as well, that we're actually increasing our staff on our strategic solutions team here, pricing, desk, and strategic solutions team, so that we're able to more freely join on these large customers, or even slightly below larger than 5 million threshold, to join you on calls with your customers and really kind of beef up your team. I'm always a big believer in the team approach to selling and having more people on, and we're here to provide any expertise or help or really get nitty gritty on strategizing on how to close deals and working on screenshots and different things that can be provided, including all our energy efficiency stuff and our demand response and our utility data box, our data platform. We're here to help you guys close more deals and get your win percentage higher and build out trust with these customers. Well, I believe that's it for today. Everybody have a great Thanksgiving, and we'll be back online here in mid-December. We'll be talking some more about the markets and some more updates here at Box and some more of our offerings we have. Have a great day, everybody. Good luck out there and really enjoy your Thanksgiving. Take care.
Thanks, everybody.